Hi guys, just thought I'd do a quick web video based on the blog article that I just published around major business for the non-major banks. Essentially, the idea for the article came as a result of me noticing quite a shift in the loans that we've written at ALIC. When I first joined the company, I would estimate approximately 90% of all the loans that we'd write would be with one of the big four banks, or St George or Bank of Melbourne, so those big, St George or Macquarie, so those big six. However, over the last 12 to 18 months, that's been a lot different. We're writing a lot more loans for our clients with some of the non-major banks, the likes of Pepper, Resimac, Adelaide Bank, Advantage, Liberty, La Trobe, etc. And obviously a big reason for that is the regulatory intervention that we've seen by APRA. And as a result of that, a lot of the major banks tightening their policies, whereas some of these non-major banks still being in a slightly less regulated environment, and hence having more open policies that can accommodate the needs of a lot of our clients. So traditionally, it's very much been that these non-banks have just competed on price. But now it's that combined with this more open credit policy that we're really finding is filling a good need and gap in the market. Evidence of this is that data that was just published by APRA showed that the volume of lending attributed to the non-banks from the third party or brokerage sector of the market has just increased by 20%. In the 12 months to March 2017, so that's quite a significant rise. And another interesting point is that the big global private equity firm called TPG, not TPG, that's another deal, KKR has recently just made an approach on Pepper Group, one of the large non-major banks. So if a large global equity firm with the stature and reputation of KKR is moving into this market, rest assured they've done their due diligence and they certainly see upside in this space, which gives us, which just provides, I suppose, a further insight. So what specifically is it about these non-banks by way of their, call it open credit policy, that can be beneficial? Well, in the blog article that I've written, there are four key examples that I've given, and I'll just quickly rattle them off here. So, open credit policy, number one. A lot of the non-banks have very lenient policy with respect to cash out. When I say cash out, I'm referring to releasing equity from your property. If you've got either a home or investment property with lots of equity, so it's worth a lot, there's a small amount of debt, you've got a lot of equity that you can essentially release to do other things, be it invest in shares, buy another house, buy a car if that takes your fancy. With the major banks, they're very strict in this area now. So they may want specific documentation to evidence the fact, or evidence what you're actually using the funds for. Maybe they want a contract of sale if you're buying a house. Maybe they want a statement of position from a financial advisor if you're buying managed funds. Whereas the non-banks will literally, some of the non-banks will literally give you this cash out if you qualify, purely just based on a stated purpose, so long, of course, as you do have the equity in the home. Point number two is leniency around what you can use those funds for, even if it extends to commercial purposes or business debt. So again, in the major bank world, this is not allowed. If you're borrowing money for commercial purposes, that's going to be associated with higher fees, commercial interest rates, which are again at least 100 to 150 basis points higher, and ultimately the security of that lend has to be via the commercial asset. Whereas in the non-bank space, there are opportunities to essentially borrow money up to maybe $500,000 for a business purpose, so long as the security is your residential house then the non-major banks are comfortable with that. So if you think about it, if you've got some commercial activities, rather than paying 5.5%-6% for any debt that you take out there, here is an opportunity for you to secure it at much lower interest rates. Call it, high threes if it's against your owner-occupied property, and low fours if it's against an investment property at the moment, July 2017. Point number 3 is just around the difference between interest-only lending versus principal and interest lending. So those loan types obviously are different. With principal and interest, you're paying your mortgage down, whereas interest-only, you're paying the interest on that debt by itself. And that's the specific segment of the market that APRA has really forced the banks to clamp down on. And as a result of that, in the major bank space, we're seeing huge price differentials between interest-only loans, much higher, versus principal and interest loans, much lower. The governments and then the banks are really encouraging clients to pay down their debt, and they're offering clients cheap rates to do that, and they're disincentivizing anyone to take that interest-only option, which up until recently, particularly in the investor space, has been very common. But in the non-major bank world, you can find banks that still have parity in their pricing of those two different loan types, so that can obviously be a large cost saver as well. And then just lastly, the difference between investor debt versus owner-occupied debt. In addition to the disparity between interest-only and P&I, so too is there now disparity between investment and owner-occupied. So again, with the non-major banks, if the debt is secured by the home, you can secure that investment debt, which is typically more expensive, at the owner-occupied rate, which again can present a major cost saving. One word of caution, there are lots of non-major banks out there, and I don't think there's a real risk that any of them are going to go under. There are certainly many protection mechanisms in place to ensure things like that would not happen. And as a worst case scenario, assuming hypothetically that it did, the risk to you as a borrower is relatively small. You've borrowed money from these groups, you're not saving your money with them. They've given you the loan, you've bought your house, you've done what you needed to do with the cash. And worst case, most likely, is that one of those mortgage books would get acquired by one of a larger institution. That said, in the 30 and a bit years that I've been alive, I'm unaware of anything like that ever happening, at least in the Australian market. So that's obviously a small risk. However, there are non-major banks that do not have residential mortgage lending at their core. So maybe, for example, they're an insurance company primarily, like AMP, that also just has a small residential lending business. And what we find with non-major institutions like that is that there can be instability with respect to their pricing and policy. And AMP is actually a good example of that, because last month, June 2017, all of a sudden, overnight, they announced that they were going to reduce the loan-to-value ratio on investment properties down to 50%, 50. So you can imagine how devastating that would be for a client that had a pre-approval in place with AMP to buy, let's say, up to 80 or 90%. Overnight, that's worthless. You can only borrow up to 50%. Or similarly, anybody that had equity in their property and was looking to take out some of that equity, extend their borrowing, say up to 60, 70, 80% in order to buy a new investment property, that type of strategy is going to be very difficult with such a limitation. So there are plenty of non-banks that we work with that have over 30 years experience in this space, tens of billions of dollars in lending. Residential mortgages is their core business, so we've got a lot more comfort moving down that path. And the experience that we've had with hundreds of millions of dollars that we've given to these institutions over the last 12 to 18 months overall has been very positive. So I guess key takeaway, non-banks in vogue at the moment, certainly increasing in popularity. They offer very compelling pricing, which is significantly cheaper than the major banks, given they don't have that big branch network and fixed cost base, and marketing spend that the major banks are accounting for. And also I've given you some examples of the type of credit policy that can really benefit you. It's not for everybody. We still do the majority of our lending with the major banks. However, certainly in the current environment where there's so much change, I think it's absurd that anyone doesn't at least canvass their options and see what's available to them both in the major bank world and the non-major bank world. Anyway, I hope you found the short video helpful, and we'll look out for you next time. Thanks a mil.